will be sharing the screen from wherever he is and is the one who will be doing the Excel computations. Yeah, he'll be able to share the document right now. So Kazi, are you able to hear me from wherever you are? Are you able to share the question for them to see? It is August 2024. August 2024. I hope Kazi is around here. He's sharing his screen. August 2024, FMDA, August 2024. Just a minute. Two questions today. All right. So this is the question that I would want us to do today. So we are told, dear Dado Limited, this is FMDA August 2023. FMDA August 2023, section 2 comprises whatever, and this is question number 21. The question of Dado Limited, a technology startup company, is seeking to raise funds for its expansion plans. The company's management is considering selling an equity stake to investors and is looking to determine the appropriate valuation for the company. Dado Limited operates in the software as a service SaaS industry and has provided you with the following information for its financial modeling analysis. We have key components of the company's projected financial statements for the next 5 years are as follows. So year 1 revenue, 5 million, cost of goods sold, 2.5 million, operating expenses, 23% of sales, depreciation, 400,000. Years 2 to years 5, given there. Note 2, the company plans to invest 3% of the projected revenue for each year in CapEx to support its expansion plans. The company will repay the outstanding loan balance in equal monthly installments over the long term of 5 years, and the loan outstanding is at 31st December 2022 is 2.5 million. The interest expense will be calculated based on the outstanding loan balance and the annual interest rate of 15%. The company's receivable turnover is estimated to be 30. The company's payable turnover ratio is estimated to be 26. The initial account receivable balance at the end of year 22 is 500,000. The initial accounts payable balance at the end of year 22 is 400,000. The tax rate will remain constant at 30% for all the years. The risk-free rate is assumed to be 12.5%. The equity risk premium is estimated to be 7. It is 7%. If you look at the answer, it's supposed to be 7%. They omitted that percentage, which of course gives very many students here issues because it's an error from the examiner's part. The beta of the coefficient stock is estimated to be 1.3 and the debt ratio is 0.4. So using Excel, perform the following tasks. Calculate the free cash flow for each year based on the historical financials and the projected future assumptions. B, they want us to determine the appropriate discount rate, cost of equity for Dado Limited, considering factors such as the risk-free rate, equity market risk premium, and then we have a beta. So I would want, of course, C, they want us to get the value of the firm, and then D, they would want us to perform sensitivity analysis, which we'll be able to do using the data table. Very easy question. Do you think, ladies and gentlemen, this question I can see here very, very clearly, it has got how many marks? It has got 30 marks in total. How many marks do you think can you get out of 30? Somebody post your possible marks that you can easily get if you are to get this kind of a question in an exam. Assuming that this question is just 30 marks. How many marks from the look of things do you think can you get by doing this question very well? Please post your possible marks. 25, wow. Wow, 26, 22, great. You guys are geniuses. Thank you so much. You guys are geniuses. You can see there is nobody who has posted 0. There is nobody who has posted 0 because free cash flow, it is something that I have to get everything. And I will start, ladies and gentlemen, with part B. So long as you label, I mean, even when you are doing your Excel, you simply come and write inside here if you want to write inside here. So I would want to start with part B, where they want us to give them the cost of equity. And then, of course, out of this, still I will be able to go ahead and give my examiner the wakaka, the one that I'll be using for discounting. So now how do we get cost of equity? To get cost of equity, ladies and gentlemen, you have to drop your screen a little bit, sorry. My great friend, yeah. So to get cost of equity, I've seen they have given me risk-free. I've seen they have given me things like better equity. So to get cost of equity, I will use CAPM. I will use CAPM to get cost of equity. So CAPM cost of equity is risk-free plus market premium minus risk-free into better of equity, So in that regard, I would want this ninja who is based at Kilifi. This is the beautiful thing with online classes. I can teach concurrently with somebody who is at Kilifi. Just imagine. So this ninja, are you able to share your screen? And then you help us calculate this. Yeah, so this ninja of mine, I hope you are able to see the risk-free. I want us to get part B first of all, where they want us to give them cost of what here? Cost of equity. And we're using CAPM. Kazi. Yeah, great. So now we are using a CAPM. Risk-free, great, plus into bracket. Remember our bracket. Returns of the market, or expected, yeah, minus risk-free, multiplied by better of equity. Great. So go to another cell there, pick your risk-free rate of return, pick those things very fast. You can even write them directly. CAPM, yes. No worries. So you can see up there, ladies and gentlemen, yeah, cost of equity. Thank you so much for bringing up that. So you can see somewhere there that the risk-free rate is 12.5%. 12.5%. Yeah. Plus, open brackets. Don't forget your brackets there. Expected returns of the market has not been given, but we have the risk premium. So risk premium is 7%. So you simply write 7% inside there. In brackets, you write 7%. You close brackets times better equity, which is in note 11. Better equity is 1.3. So times 1.3 equals, so enter there. So what figure are we able to see there, ladies and gentlemen? We are getting 21.6 like that. Approximately at 21.6%. So if you drop your screen a little bit, Kazi, so that I can explain something here. You know, risk premium means over and above risk-free. Risk premium means that they have already subtracted the risk-free rate for us. So whenever you hear of risk premium, the whole of this is our risk premium. The whole of this is our risk premium. So the risk-free, ladies and gentlemen, they have given us a figure of 12.5%. So the whole of this is our risk premium. And then we have equity beta being 1.3. And now we are able to get that particular figure there. So are we together, ladies and gentlemen, as regards this CAPM, cost of equity? Are we together? Are we together, all of us? Are we together, abracadabra? Are we together? Are we together? Are we together? These ninjas are not even responding. I don't know whether we are really together or not. I don't know. Yeah, they're saying, great. We are together. Thank you so much. Thank you so much. So, of course, in part B, they never asked us. But I'm a bright student of advanced financial management. The moment I start getting this cost of capital, I know ultimately this examiner would want me to provide what we call 𝒓𝒄𝒆. So in this case here, go ahead and give us what we call the 𝒓𝒄𝒆. 𝒓𝒄𝒆 is weighted average cost of capital. How do we get to weighted average cost of capital? We normally take weight of equity, cost of equity, plus weight of debt, cost of debt. This is interest. Remember, cost of debt is interest, and interest is normally tax allowable. Cost of equity is dividends. Dividends we don't allow for taxation. Dividends we don't allow for taxation. But cost of debt we allow for what here? For taxation. Now, ladies and gentlemen, please listen before I bring 𝒓𝒄𝒆. Before I bring 𝒓𝒄𝒆, please listen here. They have told me something very, very nice here. They have told me here that we have the debt ratio. So the debt ratio is 0.4. Debt ratio is 0.4. So when they give me the debt ratio, which is the same as WD, is 0.4, then I can very easily get the equity ratio. I can very easily get the equity ratio. I hope 𝒓𝒄𝒆 is also typing this, so it becomes easier for us to simply get his Excel and in. So when the debt ratio is 0.4, then equity ratio will be equal to what? Equity ratio will be 0.6. Equity ratio will be 0.6. Equity ratio is 0.6. Have we gotten cost of equity? I've forgotten my figure, honestly. Cost of equity, you got what figure? Cost of equity, you got a figure of cost of equity. Cost of equity, we got a figure of cost of equity. Yeah, we got a figure of cost of equity. We got a figure of cost of equity, which I would want you guys to give me. We have a figure for cost of equity already. We have it from somewhere. Cost of equity, is it messages that are moving very slowly? 21.6%. 21.6%. How about cost of debt? At least tax, I saw tax somewhere is 30%. I saw tax somewhere is 30%. I saw tax somewhere is 30%. And the cost of debt, my great students, cost of debt, my great students, cost of debt, my great students is given here. Here, not 4. The interest expense will be calculated based on the outstanding loan balance, and the annual interest rate is 15%. KD is the same as interest rate. And tax rate has been given here 30% for all the years. 30% for all the years. So, ladies and gentlemen, we have here 15%. So then, with these figures, 𝒓𝒄𝒆, are you able to give me WACC now? 𝒓𝒄𝒆 using this formula, using Excel now, are you able to give me this WACC, weighted average cost of capital? That will be really, really important in terms of my computations of what here, value of the firm, present valuation. Present valuation. Present valuation. So now it's about plugging in. You will see him taking weight of equity times cost of equity. Now we have everything. Great. Equals. So what is your weight of equity? Please pick your weight of equity. Or you can just type directly, yes. So weight of equity is 0.6 times. I'm typing direct is better. 0.6 times cost of equity, which is 21.6%, times cost of equity, which is 21.6%, plus weight of debt. Weight of debt is 0.4 times KD. KD, which is 15%. KD is 15%, but remember, KD has to be tax adjusted. 1 minus T is the same as 0.7. 1 minus T is the same as 0.7. Or you can just do it directly. Better, the better. Enter. 𝒓𝒄𝒆. Our WACC is 17.16. You can see there 17.16, which is 17.16%. 17.16%. Thank you so much. Thank you so much. The KD is in note number 4, Simbaluo. KD note number 4, they have given us the rate of interest. Note number 4, they have given us the rate of interest is 15% Simbaluo. Great. Please feel free to ask questions. Great. Thank you so much. So up to there, are we together, ladies and gentlemen? Up to there, are we together, ladies and gentlemen? Great. Thank you so much. Thank you so much. Thank you so much. The other thing that I would want to calculate before I go on before I go on, the other thing that I would want to calculate, ladies and gentlemen, no, now I can just go to the cash flow. Let's do the cash flow statements. Let's do the cash flow, the free cash flow statement. So Kazi, you can drop, I explain something small here. Kazi, let me just explain. So now we are doing part one. Now we are doing part one. You see, as other students, because I've been an examiner for this paper for long, I even invigilated students who are doing this paper sometimes back, just to get the experience. I wanted to get the experience. Most students, whenever they are doing this BDA, whenever they are doing this FMDA, most students, I don't know for whatever reason, most guys are supposed to be keenly looking at their computers, typing, looking at their computer screens, but most students in this case here tend to stare at the ceiling. For some reasons in this case that I don't understand, I've never understood. Instead of them typing, most of them, over 50% of the students are just looking up, waiting to fail so that they can repeat this thing next semester. So if a student has been able to do these kind of calculations, yeah, or they're praying, okay, if a student has been able to do this kind of calculations, I mean, these are forward-thinking students. This student will be able to pass. The student will be able to pass. Now we are doing free cash flow statement. Free cash flow. Free cash flow statement. Free cash flow statement. That is what we are doing now. That is what we are doing now. Okay. Free cash flow statement. Caroline wants us to repeat this WACC. Perhaps it is her network. So Kazi, are you able to repeat on this WACC? Kazi, please take back your WACC and try. I hope, Caroline, you are able to get cost of equity because I think that is the tough one. And then you have your, you see they have given us debt ratio. They have given us debt ratio, which is 0.4. Debt ratio, you can just go back. Did you open a different one? Yeah, they have given us the debt ratio. You can see there note number 12. They have given us the debt ratio, which is 0.4, not 12. Debt ratio 12. Yeah. So there we get KD. Thank you so much. I told you Kazi is a very bright guy. KD. Yeah. We have in this case here, you can see there tax 8T. Yeah. So then we have risk-free is 9 there, risk-free. Okay. And then of course, you can see that equity risk premium, you can mention it there. It is ERM minus RF. ERM minus RF. Yes, because already it's a premium they have subtracted for us. ERM minus RF. And then we have note 11 is beta equity, BE. Beta equity. And then we have 12 there, debt ratio is WD. Debt ratio is WD. And then Caroline, if you have WD, getting WE is very easy. Getting WE is very easy. You simply take 1 minus 0.4. Caroline. Yeah, so WE will be 1 minus 0.4, which is 0. What here? 6. 1 minus 0.4 years. Yeah, great. Thank you so much. Now then, after getting that right, you see, remember, Caro, we have our KE. Was it 21.6? I can't remember very well, but we have it somewhere there. This gentleman will be able to show it. So it's all about now combining because we have everything. And then don't forget that we have our WD. We have everything. We have everything. Now it's about combining them for WACC, which is there. The formula is already given there. The formula is already given there. Yeah. So you take weight of equity, cost of equity, Caro. Yeah. Weight of equity, cost of equity. We have everything plus weight of debt, cost of debt. And then remember that cost of debt must always be multiplied by 1 minus tax, which is 0.7. Which is 0.7. So Caro, I think that is something you can, if you have known how to get KD, then WACC, KE, I mean, WACC will not be a big thing, really. So 0.6, okay. Shiro is asking about KE. What I would recommend is that if we can just continue, and then you guys will be able to watch this video, because I believe, Shiro, maybe you came in a little bit late. I'm not trying to put away questions, but if we start going back like that, I don't think we'll finish this question really. And yet some of these things, you can follow them later on through the video, please. Please. Where is ERM? ERM, Sammy, when they say market premium, already they have subtracted. ERM is never given. When they say market premium, so it is ERM minus RF. They've just given us one number, 7%, which is ERM minus RF. Yeah. So I don't know whether you will support that I try pushing this thing perhaps through, so that at the end of the session, if you never followed, maybe we can pick it with you. I don't know. I don't know. It's quite sad, but I mean, we must move. We must move. It's quite bad, but we must move. We must move, please. Yeah, you'll watch the video, please. So then drop now, drop now. Drop now. Great, drop the screen. Thank you very much. So to get free cash flow, remember free cash flow, we normally take the famous NOPAT, net operating profit after what year? Tax. This net operating profit after tax, you add any non-cash flow items, non-monetary items. You add depreciations. If there are any amortizations, you add back. Yeah. Any amortizations you add back. Yeah. And then, of course, you'll be able to subtract any investment in CapEx, capital expenditure. You subtract capital expenditure. And then, of course, you will be able to have plus or minus any changes in working capital. I've shown you how to do this in working capital like that. So anytime they want you to get free cash flow, always remember that free cash flow is NOPAT plus any non-monetary expenses, depreciation plus amortization. Then now you come and subtract CapEx. And then we have here plus or minus changes in working capital. What about initial cash flow? Initial cash flow will come when you are computing NPV. And remember, NPV actually here will not be needed. You know, free cash flow, use free cash flow to forecast farm value, which is future from year 1 onwards. So even times 0, you will not consider times 0. All right. So then in this case here, let's get this NOPAT. Anytime we are getting net operating profit after tax, anytime they want us to get net operating profit after tax, remember that operating profit is PBIT, like that. Operating profit is PBIT. Operating profit is PBIT. All right. This is how we get our operating profit. Our operating profit is profit before interest and tax. So to get NOPAT, we normally take this PBIT and subtract what year tax. This is how you look at it. So profit before interest and tax. So anytime they want you to get NOPAT, don't ever give us anything to do with interest. You shall never bring any calculation of interest here. Interests out of scope. But of course, if you put in interest, it's another method, you'll still end up getting the same answer like we shall get. So for my case, whenever I hear NOPAT in this case here is operating profit, and operating profit is profit before interest and tax. So in this particular case, go ahead and subtract all expenses other than interest. You don't subtract interest. But any other expense shall be subtracted. I'll be able to answer that, Sherry, as I do this question. You'll be able to see. All right. So then what we shall do, I will come here and I will start, ladies and gentlemen, right away. So we are told here about year one. This was a very easy question. I don't know why they gave students this question. And they're going to repeat it. So we have year one, year two, year three. Year one, year two, year three. Year one, year two. So we have year one, year two, year three, year four, year five. Life is very good. So we start with revenue. We start with revenue. So year one revenue is 5 million. So I hope everybody is typing on the Excel, and I hope my friend Kazi is also typing. So we have cost of goods sold. I'm only copying these figures of year one. Free mark. And remember, every entry you do here is being awarded a mark. Every entry here is being awarded a mark. So we have the cost of goods sold, 2.5 million. So when we subtract this cost of goods sold, ladies and gentlemen, then we shall be able to get what we call a gross profit. Gross profit, which in this case here I can see is 2.5 million. Gross profit. So once I get gross profit, then I will think about OPEX. This examiner was very good. He has been able to give me operating expenditure directly. He's been able to give me operating expenditure directly. Operating expenditure directly. Yeah. So Prof, are we together up to here? Are we together? Are we together? Remember, OPEX is operating expenditure. CAPEX is for capital assets, for fixed assets, capital expenditure. Are we together? Are we together, really? You ninjaries and the ninjas, are we together? Are we together? Great. So then we have OPEX. They have given us OPEX. And the OPEX, ladies and gentlemen, is given here. The OPEX, they have told us OPEX is 23% of sales. OPEX is 23% of sales. So 23% of sales. So of course your sales is 5 million. You guys are very lucky because you're simply taking here equals 23% times this. So what figure are we getting here for OPEX? What figure are we getting here for OPEX? Very fast, operating expenditure. What figure are we getting there for operating expenditure? Abracadabra. 1150,000. Thank you very much, Winnie Rose. You're winning. 1150,000 like that. Do we have any other expenditure before I call on Kazi to share his Excel? Do we have any other expenditure? Depreciation. Here, don't go for shortcut, because I told you, when you're getting no part, always subtract all expenses, and then you should be able to add them back. Don't go for shortcut. No part does not want any shortcuts. Go the long way. So in this case here, we have depreciation. So depreciation, year number one, depreciation, what have they told us about depreciation? Year number one, what they have told me about depreciation for year number one is 400,000. Depreciation here is 400,000. Great. So subtract there. So when you subtract there, ladies and gentlemen, you are able to get a very important profit that we call PBIT. 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 Yeah, Ahmed Ali, that's very good, but I always tell my students, whenever you're doing no part, don't go for those shortcuts. Go for the long way. Go for the long way. So in this case here, Evelyn, she's giving me a figure of what here? A figure of 750,000. A figure of 750,000. So you're getting a figure of 750,000. 750,000. 750,000. So remember, what have we done, ladies and gentlemen, here? We have taken in this case here our gross profit of 2,500. We have subtracted in this case here OPEX, and we have subtracted depreciation. So when you subtracted depreciation, now we are able to get something called what here? 750,000. Great. Now, ladies and gentlemen, with this, are you able to go now to year number 2? Is it 750 or 950? I don't know. You know, I don't have a calculator. It's 950, I'm being told it's 950,000. It's 950,000. Now then I can easily go to year number 2. Alternatively, I know that I want no part. And because I want no part, I know no part is PBIT less taxation. So simply go ahead and less tax out of this directly. Don't bring issues of interest here. Just less tax here. Less tax, and tax is at 30%. So is there somebody who is able to give me this tax figure? Anybody who is able to give me this tax figure? Anybody who is able to give me this tax figure? So tax figure, they're giving me 285,000. What have they done to get this tax figure? They have taken 30% of 950,000. 30% of 950,000. Yeah. So in this case here, come and subtract. So then what figure are we getting, ladies and gentlemen? What figure are we getting here? When you subtract, we are getting 665,000. 665,000. All right. So this is basically what we call no part. Net operating profit after tax. Net operating profit after tax. And then remember, once you get net operating profit after tax, now you need to come and consider the other things. Add depreciations back. If you have any amortization, you add back. All right. If you have any capital expenditure, subtract etc. Subtract etc. All right. Like now here, we know that we have depreciation. Depreciation that we had calculated here, which was 400,000. Don't add. I don't want to finish it because we still have the capexes. We still have the working capital to come and make adjustments. So don't do anything. Let's go to year number 2. Let's go to year number 2. Let's go to year number 2. PBIT, I'm being told, is 750,000. PBIT, I'm being told, is 750,000. Ladies and gentlemen, do you want to tell me that you are taking this 1150 minus 400? Is that what you guys are doing? You know, all these figures are supposed to be taken out of gross profit. We take gross profit, 2.5 million. We subtract any operational expenses. We subtract any other expense. Then we shall be able to get this 950. Is there somebody who is subtracting like this minus this? Honestly, we shall overcome. We shall overcome. We cannot blame anybody. We can't blame anybody. Thank you so much, Philip. We can't be. So then, is this correct now? This 665,000, is it correct? Now we are together. Is this correct? 665,000, is it correct? Yes, thank you so much. Now then, let's pick. Once I get my year 1 correct, picking the others now will become a walk in the park. Let's see. Let's see. Kazi. So Kazi, now your work is starting here. For year number 2, you can see revenue is expected to grow at the rate of 10% per annum from years 2 to years 5. So Kazi, you can share now your screen. You give us the new revenues from year number 2 to year number 5. Kazi, the floor is yours now. Great. Great. So now we are picking from year 2 at the rate of 1.1. Yeah. So revenue growth, thank you very much. So revenue growth, 10%. So year 2 equals. Yeah, you can lock it. If you're using that approach, you must lock it. Yeah, and then now you can pull it. Yeah, you can expand it a little. Yeah. Okay, so at 5%. Now, Kazi, just a little bit, go back there to that revenue. Can you Control Z? Can you kindly, in this case here, go back to the original Control Z? Let's go back there, or you grab the figures that you have there. Control Z again. Yeah. So I would want you to start again. So take that equals, that cell with 5.5. I want you to say equals there. So equals, you say 5 million, take the 5 million. Take that 5 million times 1.1, because you see growth rate is 10%, times 1.1 directly. 1.1. That's another method Control enter or enter. And then now please pull it the other side, pull it the other side. Yeah, please in this case here, try to abracadabra there, expand it. We'll get the same answer. That method is very good for the students who don't like locking things. The students who hate locking like nothing. So that method becomes very good. Beatrice. So then you will be using that approach. Now go to cost of sales. Go to cost of sales. Sorry. Just a minute. All right. So I can see Tess there. Tess does not like this method of someone else doing it. This approach is very good. When we reach this time when we are almost there in this exam, using this approach is really, really good. Yeah, you'll be able to see things that you would not have seen if I was doing it without my whiteboard. So the whiteboard also assists. I'm 100% sure there must be some students who are able to appreciate, and everybody. Yeah, everybody, you'll be surprised. You'll be surprised. You'll be surprised. You'll be surprised. All right. So thank you. So of course, even if you hate this concept of locking up, locking is very, very good. Locking is very, very good, especially when you will be doing sensitivity analysis. Yeah, when you shall be doing sensitivity analysis, it will be very, very good for us to have locked those metrics. So it's good to lock. But if you feel that you don't like locking, then in this case here, you can, but let's lock them. Let's lock them. Let's lock them. Let's lock these figures. Let's lock the figures. So Kazikazi, I hope you'll be able to lock very fast. That 10% is going to be constant throughout. And because of the constancy, then we have to do F4 or function F4 to put those dollars to lock it. To lock it. Yeah, it's now showing it's locked. Thank you so much. Now you can close brackets and then you do your abracadabra. You do your abracadabra times that, yeah. Great. Great. How about cost of sales? Remember cost of sales, they gave us some rule there. Are you able to see the cost of sales rule? From year 2, cost of goods sold is 50% of revenue. Is 50% of revenue. Is 50% of revenue. Is 50% of revenue. So equals, so we have that 50%, that has to be locked because you can see it's a constant number that will be used throughout. Yeah, times the revenue, which is up there for year 2, 5.5. Great. Then pull it by the ears to the other side. Great. So do we have a rule for operating expenses? Do we have a rule for operating expenses? Year number 2, operating expenses. They are 23% of revenue. 23% of revenue. 23% of revenue. 23% of revenue. Yeah, OPEX is there, 23% of revenue. 23% of revenue. It has to be locked, of course, right? Times the revenue up there, enter, and then now you move across like that. Now give us something to do with revenue, or rather depreciation, sorry, depreciation. So depreciation for 400,000 across. You can just pull the one that you have there for year 1 because the year 1 is 400,000. Pull it by the ear. Shika masikio uruta. Oh, you can't see. How comes I'm able to see? How comes I'm able to see very well? Yeah, we can see very well. We can see. And then now PBIT, already we have a formula for PBIT, isn't it? Yeah, depreciation is 400,000. So now we have a formula. We have a formula there. So cheza kama we kazi. Yeah, cheza kama we kazi. You can see already it's that. Already we have a formula minus that. So shika masikio, vuruta. Yeah, very good. So tax, we already have a formula for tax, isn't it? Yeah. Tax, we already have a formula, put it there. Tax rate 30%. Yeah, that's a very good approach. That's a very good approach. That's a very good approach, 30%. So enda pale, kumbuka tax you take. So lazima useme equals ones are fresh. Yeah, lock it times the 950,000 up there. 950,000 can't be locked. That one has to be left to dance. Yeah. You know, ladies and gentlemen, I always keep on joking with you that we always lock those things that cannot move around, the constants, just like accountants. You see, I've never met an accountant who knows how to dance. Never. So if you get an accountant, lock them. Lock them. They're constants. Yeah, you can see now everything there is okay. Very good. How about NOPAT? So NOPAT, you are taking that operating profit. You less the taxation. You less the taxation, yes. We less the taxation. Kendi, you can only dance here, but physically you cannot dance. Very good. So we have that depreciation. You can pull it from up there. Depreciation. All right. Yeah. And then now you can do your magic there. You can do your magic there. So, ladies and gentlemen, all of us, don't subtract anything. Leave it like that first. So, ladies and gentlemen, all of us, are we at par with kazi? Are we at par with kazi? Great. Now, let's go ahead and read something to do with capex now. Let's read something to do with capex. Are you able to see capex? What have they told us about capex? Capex. The company plans, note 2, the company plans to invest 3% of the projected revenue for each year in capital expenditure to support its expansion plans. So please go ahead and write that 3% amongst your assumptions, then lock it and then use it to get the capex. Great. Thank you, Mr. M. Great. So capex is 3%. 3%. So now come there, capex. Capex equals the 3% there, 3% there. Lock it, just like an accountant who can never move, who can never dance. We lock you. Great. Times, it's on the basis of the revenue, projected revenue for each year in capital expenses. So times, yeah, that projected revenue there. Great. Control Enter, and then you pull it by the ear. Now, great. Now, from there, ladies and gentlemen, I would want us now to work on working capital. This examiner was a crazy examiner. If you drop down a little bit, just to explain here using my board. If you drop down a little bit, I want to explain something using my board. Now, you see here, we are used to situations where the examiner gives us working capital is 10,000, or this 10,000 will be injected. This examiner never gave us working capital. He chose to use receivables and payables approach. Receivables, analog 3%, analog 3%. Becky, analog 3%. Ebu kazi, rudisha screen juu, tuone kama unlock gani. Au nasema umelock kitu tofauti, ebu tuone tusikosee. Tusikosee. Did not get capex, Sayed did not get capex. Also explain capex. Ebu acha tuone. 3% of the projected revenue for each year. So 3% is locked. 3% is locked, right? Kazi, what is locked here? 3%. 3%, that is, yeah, 3% is locked. And then the revenue is not locked. Becky, unasema gani Becky? Becky unasema, amefanya vizuri kazi. Iko sawa Becky. remember, Lizzie, I gave you another approach for those students who do not want to lock. You'd only lose those marks down there of sensitivity. Don't get to pass. Don't fail to pass simply because of locking. Yeah, you can as well put negatives if you wish, or you leave it like that. Because when we will subtract, you'll be able to stake there no part, you add depreciation, and then you less capex. One are the same. Or you put them minus zote. Ukitaka, lakini tuendelee mbele. Catherine, thank you very much. Mary, wacha tuendelee mbele. So sasa, nataka turudi pale, I hope Said also umeshaona vile tunafanya. Nataka tuende pale kwa receivables. So sasa angalia, weka kwanza chini kidogo kaskazi. So kaskazi, nataka tupate receivables. I want us to get receivables here. So receivables, what this examiner has done, he has given you the receivables turnover ratio. This examiner was a tricky examiner. This examiner is just like myself. I like, in this case, you're teasing students. You tease students in a way that, kama ameenda exam room na high-heeled shoes za red msichana, na kuambia utatoka hapo ukienda kwa gari yako, umekanyaga chini, umesweat. Na si ati ni ngumu, kutrick tu, na kutrick namna hii kidogo unamwagika, na kutrick hivi kidogo unamwagika, kama goalkeeper wa Manchester United. Very good. So tukuje hapa sasa, hapa. Unaona hapa amesema the company's receivable turnover ratio. The company's receivable turnover ratio is 30. So they have given us receivable turnover ratio. Receivable turnover ratio. The person who taught me alinifunza kitu mzuri sana. Aliniambia sababu ni ratio, sababu ni fraction, inafaa kuwa hivi Yeah, inafaa kuwa hivyo. Ati ni receivable over turnover. Lakini ukienda kuandika formula, you inverse because you see it's turning over. So unaanza hapa na kuandika turnover over what year? Over receivable like that. This is how we get receivable turnover ratio. This is how we get receivable turnover ratio. You take the turnover. Turnover is the same as sales. All over receivable. So this is receivable, turnover, turnover ratio, like that. But you see now, we have the turnover. We have this receivable turnover ratio. What we don't have is receivable. Make receivable the subject of the formula. So can you kindly cross multiply? Oh yeah. If you bring this one here, alafu uchukue, itakuwa turnover all over receivable, turnover ratio. So I don't know whether you guys have been able to write this formula there in your Excel. Yeah. Simbaluo, I'll get your number, especially when results are out. That, is it TOT or TOT? I don't know. You will have to pay for it. Yeah, sasa, kazi, you see kazi, we have the turnover. We have, turnover is the same as sales. Turnover is the same as sales, isn't it? And then they have given us receivable turnover ratio, which is 30 throughout. Hebu tuone kama kazi, kumbuka unafanya working candle, hii usifanya kwa hii table, hii working ya working capital, utaifanya kando. Alafu tutaleta final figure hapa, utaifanya kando. Oye, kando kidogo kazi. Pale kwa working capital, andika working capital kando kabisa. Chini kabisa, ruka hata line kama na not tisa wewe, 3 hivi. So working capital, uniandikie receivables for years 1, years 2, years 3, years 4, years 5, like that. So I want to take the sales for year 1. 5, is it 5 million or something? you divide by 30. This 30, you can lock it somewhere. Kaskazi, 30, you can lock it somewhere now. Kaskazi, kazi kwako. And now Tess, I hope you're able to see why I chose to work with the board. To work with the board. Tami nitasema kama Dr. William Ruto, mimi si wazimu. At times this thing works. Yeah, we have so many shortcuts and ratios. Lakini hatuwezi leta hizi admin, hatuwezi leta hizo vitu zote hapa. Tumalize kwanza hii. Tumalize kwanza hii sasa. Yeah, so receivable. Yeah. So let me keep quiet a little bit for Kaskazi. Kaskazi. Kaskazi is your classmate. We'll be doing together with him this exam. I realized his potential when he was doing attachment at Aura and Co. He came and did his attachment in my audit firm at Westlands. That's when I realized this guy, hey, he doesn't speak. I doubt whether, if I ask him whether he can speak, he doesn't talk. But he's very good. He's very good. He's very good. You need to do quiet, soft spoken. Although I'll have to train him later how to talk. It's important for an accountant. Keep on talking like me. You can never go wrong. Yeah, so turnover ratio is 30. And you see that 30 is going to be constant throughout. 30 is going to be constant throughout, all the years, yes. All the years. Can I find attachment? We can talk about that after you have passed, After you have passed, let's talk about that next semester. You know, now we are going to the low season of audit. Who is this guy? Who is this other ninja who is sharing his screen? Without my permission, honestly. This kind of a ninja is making Kazi's ninja to disappear. Screen to disappear. So now Kazi share again. Share again. Share again. Kaskazi, very good. It's called Zak Kaskazi. Yeah. So the turnover ratio is 30 every year. We know now the formula. Yeah. So now give me the receivables. Give me the receivables. Now give me the receivables. Give me the, hey, we said we are doing 2 questions. Shall we be able to do 2 questions really? We shall overcome. Okay, sawa. Sawa. All right. So then you guys, are you able to get those figures of receivable as I repeat? As I repeat, the figures for receivable. So Kazi, you can drop down your screen. Yeah. So Kazi, you can drop your screen down there. So now you see line. Is it line or linear? I don't know. You see receivable turnover ratio. Receivable turnover ratio. Yeah. Receivable turnover ratio. Ukaambiwa na mwalimu unaweka hivi over. But ukiandika formula, you turn over everything. So inakuwa ni turnover over what year? Over receivable. Over receivable equals receivable turnover ratio, like that. So cross multiply because I want receivables. I want receivable. So cross multiply, if I cross multiply times receivable equals turnover, like that. So I want receivables alone. So divide both sides by RTR. And you see now, the receivable turnover ratio is 30. And the 30, they have not told us whether it will be changing. Yeah, so you divide. You can see here, you take the turnover, you divide. You divide like that. To get receivable, you take the turnover over RTR. So like the 5 million divided by 30, next one you divide. So now, are we together? Are we together? In some way, are we together? Are we together? Are we together? At least today, you guys are very, very positive. I'm so happy. Even Becky today, I can see you are very, very positive. You're making cries like I have to remember AFM. No. Today we are asking good questions here. Great. Sheria amesema mwalimu aongeze, nitawadai. Unajua mwalimu haendi hoteli ya kibanda. Mwalimu haendi hoteli ya kibanda. Nitawadai. Aya. So we have receivables. Now, hey, you ninjas, let me see whether there is anybody who will be able to get the payable turnover ratio using the shortcut ambao nimekupatia, the payable turnover ratio. The payable turnover ratio. Payable turnover ratio. Oh, too fast. What do you mean? The way we have gone very slowly, but we shall overcome. We are blessed. Thank you so much, Elizabeth. We are blessed. Yeah, very good. 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 Sasa hapa lazima ukuwe mwanafunzi mwerevu. Mwalimu wangu aliniambia, akaniambia vizuri sana. Anytime you see this payable turnover, wewe kuja geuza tu. Kwanza sema hivyo payable over turnover. Alafu kuja uandike tena payable turnover ratio. Andika tu, lakini kwa umegeuza sasa. Useme turnover, useme namna hii. Turnover over payable. Sasa kutoka hapo utingize kichwa kidogo. Si kila saa unakuwa constant rigid. Tingiza kichwa namna hii. Akili inafanya kazi mzuri kabisa. Yes, inafanya kazi mzuri sababu you see, for me to get payable does not come from what I sell. Payable normally, you know, turnover is sales, eh? Payable normally comes from what I purchase. Where? Hapa alisema tingiza kichwa kidogo. Hapa. Payable normally comes from purchases. You purchase, you pay. So akasema hapa una change hapa. Unafanya hivi, unaandika jina namna gani? Purchases hapa. Alisema namna hiyo. After umeshatingiza kichwa. After umeshatingiza kichwa kidogo, hapo unaandika purchases. Yeah. And then in most cases, purchases will not be given. In most cases, purchases will not be given. If purchases is not given in accounting, where does it fall under? Cost of sales, yes. Because normally to get cost of sales, what tunasema namna gani? Somebody opening stock plus purchases minus closing. So pia kasema, hii kitu ya payable like that. Turnover ratio can also be in terms of cost of sales over payable like that. So uskram useme ni cost of sales, sababu ukipata examiner kama mimi nitakupatia figures of purchases. Nitakwambia my purchases 50% of my cost of sales. Nitakudanganya namna hiyo. Nita make sure umetoa jasho. Tena umetoa jasho kwa wrong places. You see in life, ukifanya exam, ili utoe jasho huku ndani. Ndani mbele. Kuliko kutoa jasho kwa dhidi hapa. Kila mtu ana sweat hapa. Na huyo mtu sio mtoto sana. Huyo mtu ni 30 years and above na ana sweat hapa kwa dhidi. Hata kwa interview. Disastrous. International disaster. Yeah. All right. So then, have you guys been able to put this in brackets? Or rather, have you been able to highlight? Yes, ratio means, it doesn't have to be percentage. No. It's a medical. If it's medical, then that's okay. So payable turnover ratio, allow me to write something here. We are saying now, you cram it this way, that payable turnover ratio will be cost of sales all over payables. But should you get an examiner who tells you that purchases is 50% of cost of sales? I repeat this. Should you get an examiner who tells you purchases is 50% of cost of sales, please always ensure you multiply this with 50%. Very, very important. But now remember, the examiner wants us to calculate payables. So my payables here will be cost of sales over PTR. Because when you cross multiply, You divide both sides by PTR. So now kazi kwako, kuja hapa tupatie payables, give us a payables row just beneath there, cost of sales. I want you to give me payables. Payables. So for payables, I want you to take cost of sales. Cost of sales for each year has been provided here. Like year number 1, you take 2.5 million. So you take 2.5 million, you divide by the payable turnover ratio. You divide by the payable turnover ratio. So kazi, and we're great. Thank you so much. So now we are getting payables for each year. Yeah, and I can see he has already prepared a schedule there. First of all, he wants us to fetch cost of sales. So cost of sales for each year. Cost of sales for each year. It is there. He's fetching this. Yeah. Enter. And then you pull. Yeah. Enter and pull. So from there, you can even now go ahead and give us the payable turnover ratio. Payables turnover ratio. Turnover ratio. It's given somewhere. Already, up there. It's showing me up there. So where is your figure for locking purposes? Where is your figure for the PTR ratio for locking purposes? It is somewhere there. Thank you so much. 26. Thank you so much. Yes. Now, please, let's now compute that. Divided by that. Great. Thank you so much. Great. And then now you'll be able to, great. So then, ladies and gentlemen, go ahead and give me, give me working capital. You see working capital there will be receivables minus payables. Working capital will be receivables minus payables. Receivables minus payables. Working capital will be receivables. Yeah. First of all, leave out that. I don't know, you must make an assumption. Leave out that. First of all, give me the, yeah. So please go there, create a column, a row for working capital. Working capital. Yeah, working capital. So if you remember very well, working capital is current assets minus current liabilities. So here we only have one current asset, which is the receivable, minus one current liability, which is the payable. Yeah. Enter. Yeah. And then now you can be able to, great. Thank you so much. And then now go ahead and give me a column there for changes in working capital. A row for changes in working capital. Changes in working capital. Changes in working capital. So you see the first one, we start from 0. So 0 minus this. 0 minus what we have in year 1. 0 minus what we have in year 1. Minus what we have there. The examiner was serious, Great, that's it. That is it. And then now you, yeah. Great. Have you seen what this guy has done? Is there somebody who has been able to master what he has done? Because like now, for year 2, it is 77,564 minus 70,512. So what he has done is a clever guy. He has been able to go to N, that is 46, N46, and he has been able to put 0 there. He's been able to put 0 there, and then he has been able to use a formula just across. Just across. Is there somebody who has been able to see those increases? The increases in working capital. Yeah, Carol, I can see Carol is telling me, Mwalimu, read additional information, number 7. Thank you very much. I'll read it. But first of all, before I read it, have you been able to get this? Have you been able to get this? Life is very good. Next week, when you guys will be doing your exams, I will be traveling. I'll be a happy man. They haven't gotten yet. Mary has not gotten yet. Are you able, Kazi, are you able to do it like slowly for them to see what you have done? Maybe you subtract. Yeah. You see, we are starting from 0. We are starting from 0. Yeah. Changes in working capital. You can even write 0 there, Kazi. Write 0. I don't know whether you'll write somewhere. Yeah. So we have our 0 there. And then now when we go to year one, you see year one, we are, yeah, actually it will be better even to write like that. That's year one, isn't it? Yeah, year one. And then when you go to year two, so for year two, you'll simply take minus that, yes. Yeah, so old minus new. And then now you go to, even year two, actually, you can even again repeat it. It's that one minus year two. So year two, you take year one minus year two. But once you do for one cell, then you should be able to use the expandable. Yeah. All right. All right. So then all of us, have we been able to get that working capital? All of us, have we been able to get that working capital? Beatrice, good. All of us. The changes in working capital. Great, 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 great. So ladies and gentlemen, nafikiri wanafunzi pia wamechoka na nataka kuendelea. Ni song gani naweza yakia wanafunzi kidogo wakatike kidogo? Na najua mambo ya song kidogo. Dakika 3. Na najua mambo ya song kidogo. Start from working capital. Rael Ekirapa, my friend. Working capital. Nataka urudi nyuma kwa working capital. How do you get working capital? Remember working capital, Rael? It is receivable in this case minus payable. No, Kasongo is political. Sally, we don't want to do politics here. We want something neutral. So, Rael, just check again. Tutavuka, yeah. Hiyo nitaimba ile siku ya mwisho. Siku ya mwisho tukinta, Working capital is current assets minus current liability. Current assets minus current liability. All right. All right. So in this case here, we take that minus the payable. You take the receivable minus the payable. All right. Once you get that, then you'll be able to pull. Payable, remember payable is current liabilities. Payable is current liabilities. No, I'll be able to explain BK. I'll be able to explain right now. Nataka kuchukua break kidogo BK. Lakini break imekaribia time za kumaliza class. All right. All right. All right. All right. All right. Now, ladies and gentlemen, I must have taught like all of you here. Please drop down. Drop down. We shall not take any break. We shall not sing any song. We shall not sing any song. We shall not sing any song. Iko mamesema tuimbe Christian song. At times pia inafaa unaangalia pia mambo ya dunia. Nakwambia kitu usingoje ati Christian. Kuna saa unasikia mambo pia ya dunia. Hii muziki ya dunia ingine iko na masomo mengi sana. Iko na masomo mengi sana. Kama ile tunasikiza zile za wazee za kitambo, ziko na masomo 1 million. Hata za vijana siku hizi, iko zingine ziko na masomo. So unapita tu mahali kama kwa gari, unasikia mtu amekuimbia wimbo anakuambia ati mimi niko na mali na hiyo mali ni ya babako. Kasikie vibaya huko kwenu. You see now it means as I'm saying I should never joke with my money because my son will be told that one day. I mean that thing has got a lot of message in there. A lot of meaning in there. Kijana wangu anaambiwa kasikie vibaya huko kwenu. Mali imeenda yote. Yeah, so we need to learn. We are learning every day. We are learning every day. Yeah, we are learning. We are learning every day. We shall overcome. So then let's continue now here. So where are we, my friends? My friends, where we are, in year 1, we've been able to get no part for year 1. So year 1 no part, we got a figure of 665. And then we said we add back depreciation. We add back depreciation. We add back, and I remember very well depreciation here, it's 400. And then now we have in this case here what we are calling changes in working capital. Changes in working capital. Changes in working capital. So changes in working capital, I'm going to make a very, very good assumption that whatever working capital you are given at time 0 is existing working capital for the farm. And it's not working capital for this new project. Remember, when you're doing farm valuation, we always prefer everything to be new. We prefer everything to be new. We don't look at the existing working capital. You must tell us in this case that you shall inject working capital of this into the new project. Yeah, and if you look at the solution that even Kasneb has given for this question, they never bothered with the historical working capital. We normally put that one there. If you remember very well your AFM, we normally put that one there to confuse you. However, in an exam, if you use it, then we shall be able to choose to close an eye and say this is a brilliant student. All right. So in this case here, come and give us our changes in working capital investments. The first one is minus 74 something, isn't it? The first one. Oh, there is CapEx. There is CapEx, yes. Yeah, there is CapEx. We have CapEx. Don't forget CapEx. I was almost forgetting it. Yeah. So we have, please, let's put CapEx here. So what have they told us about CapEx, first of all? What have they told us about CapEx? Kaskazi. Let me share mine. Kaskazi, first of all, let me share mine. Kaskazi, let me share mine first of all, and then I get to see what they have told us about CapEx. CapEx. What have they told us about CapEx? I'll be finishing this question in the next 2 minutes. What they have told us about CapEx somewhere, I can't even see where it is given there, and I'm shouting. Where is it given? Yeah, note number 2. The company plans to invest 3% of the projected revenue for each year in CapEx to support its expansion plans. So it is 3% of the revenue. 3% of the revenue. So we have here 3% of the revenue. So CapEx here, the first one, it will be CapEx. The first one, it will be 3% of 5 million, which you guys had already done, isn't it? Yeah, so put a figure 3% and then we'll be able to pull this thing across. So kazi kwako tena. Kazi kwako tena. Aliyah will be telling you, don't worry, it's too early, Ali. It's too early. Yeah, so in this case, now we are doing this. We are finishing this table. We are finishing this table. We are finishing this table. So please go back there. We are done CapEx. Thank you so much. So in this case here, bring the changes in working capital. So change in working capital, pull whatever we had there. Pull whatever we had there. Yeah. Changes. That one, yes. Yeah, from year 1, yes. Thank you very much. And then Kazi, you remember students were telling you to, yeah, pull by the ears. Oh, you want to make, I wanted to be negative. It should be negative because we are investing. I wanted it to be negative. We are investing in receivables. We are investing in receivables. Let it be the way it was. And then if you don't mind, can you kindly change that CapEx also to be negative? It will be easier that way. Yeah, change CapEx as an outflow to be negative, and then you pull through. You pull through. And then now, ladies and gentlemen, you should be able to give me free cash flow. Mandela, we are free. I'm so happy. Today I will sleep a happy man. Free cash flow. Great. So free cash flow, you start from no part. Yeah. 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 Up to changes. Yes. And then value of the farm. Value of the farm. I hope you remember our WACC. Go ahead and give us our present valuation. I don't know whether you want to take a shortcut or you want to give me the PVFs there. Present value interest factor. I don't know the method you want to use. Present value interest factor. And remember that our cost of capital. Are you able to remember our cost of capital, Becky, before I answer you? Are you able to remember our cost of capital? Are you able to remember our cost of capital? Caroline, 15. It was 17.16. 17.16%, yes. And then remember the formula of getting a PVF is 1 plus R raised to negative N. Yeah, great. So PVF, 1 plus 17.16. Already we have it. And then we have to lock that one because it's a constant figure. Because it's a constant figure, you must lock it and then you pull through. Great question there. Great question there. Great question there. I can see all your questions and I'll not ignore any. I'll not ignore any question. So raise to power. Now you raise it to power 1 up there, right? Power n, eh? So raise this to power. Yeah, you can use an PV formula, yes. Power 1, yes. And then, of course, now you can pull through. You hold it by the ears. Kama jana, kamvulana kangu kalinikosea kidogo, nikakavuta masikio. Kalilia. Nakavuta na hapo masikio chwa. Kalilia. Great. Yeah, it can't be 1 point. It has to be, yeah, 0 point. Thank you so much. Now, after that, now you can easily give me the PV, the present value. Give me the present value. Give me the present value. So present value, you're taking the free cash flow times that one. And then you pull. And then you give me the total now, the total present value. Total present value, which will be a sum of everything there. Total present value will be a sum of everything there equals, great. So that is what we call value. Is it 3.3? You guys got? Repeat on the PV fair. Present value is 33, 35 or something, eh? PV. So 1 plus R raised to negative N. Perhaps if you could just drop the screen. If you could drop the screen. If you could drop the screen. So when you drop the screen, we get in this case, ladies and gentlemen, PV. We know that PV, present value, interest factor, is 1 plus R raised to negative N. All right. So then you will come on top of 1 plus. You see, this R has to be dollarized. You must fix this R. And then now you come and say raised to negative N. Don't say negative 1. You will say raised to negative. You pick this one up there. And then now you say enter. And then you pull across. 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 I hope that makes now some sense. Because the R is WACC. The R is WACC. I will repeat that, Becky. The R is WACC. Is that okay? First of all of us, are we able to get, in this case here, this PV now? Yes. And then now do your multiplications or use the shortcut. There's the shortcut of getting any PV. You guys are very good with that. You're very, very good with that. Now, ladies and gentlemen, this question is an ACCA question. The examiner forgot something very, very important. He forgot the perpetuity. At this level, we should be able to bombard you with lots of information. He forgot the perpetuity, that after the 5th year, I don't know why he forgot that. After the 5th year, the cash flows will grow by 5% per annum forever. He forgot that. I'll be able to give you the original question and the answer to it. He forgot that. It shall be there. That one is very, very important. But the perpetuity, if you remember, perpetuity is the Gachagua formula. Do you remember Gachagua formula? Do you remember Gachagua formula? Yeah. Yeah. The perpetuity is Gachagua formula. Perpetuity. If you're told in this case that this thing will be growing indefinitely, that will be Gachagua formula. And we know Gachagua, it is provincial officer. He was a provincial. No, first of all, it was a DO. He grew in ranks. Yeah. And then you come and divide this one here by Kenya without government. If you remember this very well, Kenya without government. This is Gachagua's formula that Gachagua, no government. No Gachagua, no government. Yeah, actually, when you look at this thing very well, very, very well politically, Dr. Ruto did a mistake. Kutoa Gachagua. Hiyo kelele inakuwa mingi sana. If you are Ruto, to be very honest, regardless of what this gentleman had done, ungemtoa kwa kiti kweli? Wewe tupumzike kidogo mkijibu. Ungemtoa kwa kiti kweli? Ungemtoa kwa kiti? Ule jamaa alikuwa ni defender. Hawataki siasa hawa turudi hapa. But now remember, whenever we are doing, although we shall come back to this tomorrow, For now, we've been able to get the total value of the farm. Once you get the total value of the farm, remember from Modigliani, once you have total value of the farm from Modigliani, we know that value of the farm will be equal to debt plus equity. So this value you're getting there, 3 point whatever, we have our debt. Our current debt is 2.5 million. They have given us something to do with our current debt. Remember, we've been able to present value this from the very future to the present. And presently, we have a debt of 2.5 million. All right? Oh, okay. Don't worry that. Don't worry about that. So then we have this 2.5 million. You subtract to get, please, if you look at the question, 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 yeah, you can share the question in this case here, Kazi, as we finish. I just want to show them the question here. I want to show them the question here. D, come on, Italine. Ruto, please talk to me. Talk to me. It will be good teaching the president's daughter, isn't it? Yeah. So you can see somewhere there, they have given us something to do with that. The company will repay the outstanding loans balance in equal installments over the loan term of 5 years. The loan outstanding is 2.5 million. So this is the loan you subtract to be able to get that. Please go to the question down there. Go to the question itself. Part C of this. They want us to determine the value of the farm and the value of equity. And the value of equity. So then the value of equity will be the total value, farm value that you guys got there, minus the 2.5 million. Now, to answer Becky, please go back. Go back. There is something here. Okay, I have two great questions that I must answer before I retire. We have this question on the receivables. You see, you can opt in this case here to start with this 500, and then we have in this case here payable of 400. So you can opt to start from there. But remember, for farm valuation, we always think about the future. So anything given regarding these opening balances for working capital, we shall always disregard this. When I share with you the solution, you'll be able to see the solution. Anything given to do with working capital, opening balances, disregard them. But again, let me ask you a question, ladies and gentlemen. If you drop that screen, Kazi, you see, I should not even bother a lot with actually finishing this question. By the time you reach here, you are exceptionally a very good student. By the time you reach even at no part, how we mark those ticks 1, 1, 1, 1. By the time we reach the no part figures correctly, you have scooped almost all the marks. And then, of course, you must be having that WACC. You have a few correct figures on the payables, on the receivables. You will have scooped all the marks. We are not looking for perfection in BDA. We're looking for perfection in FMDA. Actually, if you go for perfection, you shall fail. My students, this life does not need perfection. Even in your marriage, if you pursue perfection, you will be chased away. No, we must agree that all of us are imperfect and learn how to, coexist. So the same with the exam. So if you try in this case here, like now looking at, like now what I'm trying to teach you here, equity. How many students in Kenya will be able to get this equity figure correctly? How many students in Kenya will get the equity figure correctly? 1 or 2? Or even none? So don't bother about perfection. Actually, moving forward, because I'll be coming to assist your teachers now, given that now we're going to the exams, moving forward, I will just be teaching you what we call low-hanging fruits. Like, for example, those students that I taught last semester, AFR, were you very, very bright for you to have passed AFR? No. It's about being able to harvest. Being able to harvest something here, something there. But if you chase for perfection, what normally happens with this paper, so many people break down at the very last minute. I've seen students who break down. And that will be the worst thing for me as your father, seeing a person breaking down because of a paper that they will easily pass with a lot of imperfections. So the thing is, if it is the audit schedule, out of audit schedule, what are these low-hanging marks that I can easily harvest? That is what we shall be answering. Helicopter style, yes. Thank you, Brian. Yeah. So that is the approach I want us to move on. So when you see you're asking a question and then Mwalimu is not even answering, I mean, leave it. Leave it. So another thing I was asked here, how about interest? If you put interest and I don't put interest, we will get the same answer. Because when you put interest, later on, you will be adding back interest minus interest into 1 minus tax. You'll get the same answers. Yeah. Thank you so much. We shall overcome. I wanted to extend, but I'm so tired now. I'm so done. I'm so done. Good night. Be blessed. See you tomorrow at exactly 8. Yeah, we shall overcome. We shall overcome. Good night. Thank you so much to this great guy called Kazkazi. He has done a very, very good job. He has done a very, very good job. And the Tess, I hope you understood why I decided to use the board a little bit. Tess, I hope you understood why I decided to use my board. I'm waiting to get Tess's, yeah. I'll do part D tomorrow, yeah. Great. Thank you so much. Sleeping happy, okay? Oh, okay. So Kaskazi will be able to share. Thank you so much. Tess has not spoken to me. Yeah, I can see Tess has spoken to me. Great. Now I'm happy. Great, great. Thank you so much. Be blessed. Say hi. Thank you, Elizabeth. We shall overcome. We shall overcome.